Hi, and welcome to this month's Trade Floor Update. Today I'm joined by Rob Mead, Co-Head of Asia Pacific Portfolio Management. Rob, popular sources of income are under pressure. We have term deposit rates declining and even Australian bank dividends are being cut. Now this is forcing investors to look elsewhere for income. My question to you is, do you think this theme is likely to continue, and what can investors expect from bonds?
So if you think about in history, it was very easy for an Australian investor to build a barbell portfolio, earn a positive real return in the term deposit, so 4% in some cases above inflation, and have listed equities and direct property at the other end of the spectrum. So that barbell actually worked very well. In today's environment, it doesn't work anymore. And really, the reasons for that is, first of all, term deposits, as you just said, are already generating negative real returns and they're going even lower. And you can't use equities for income and growth, especially, as you said, with dividends being under more pressure, royal commissions, regulatory changes, underlying economic growth being slightly weaker. So investors need to be thinking about their portfolios much more actively. And the way we think about it is they need to fill the gap. They need to fill the gap between what they had in term deposits and equities. And some of the ways to fill the gap is to add some more defensive assets, add some more alternative sources of income, even add some illiquidity and complexity premium in there. And that's exactly what PIMCO is focused on in terms of what we're trying to deliver to our clients.
Where are you finding the most attractive investment opportunities, both here in the local market in Australia and globally?
Yeah, I think I'd build on that same concept of sort of defence and income and thinking about both of those independently. So in the defensive bucket, we still like US Treasuries, Australian Commonwealth Government bonds, even state government bonds. Those sleep at night assets that will protect your portfolio. And we know markets are being moved around by a headline or a tweet. You want some of that defence in your portfolio. In terms of income, we think that it's then much more appropriate to think about that globally. So globally, we prefer the securitized asset space, so including both agency mortgages, which are backed by the US government, provide some additional premium or additional income opportunity versus a treasury, but also have those defensive characteristics. We also like some sort of exposure to the US consumer. The US consumer is one of the very few sectors globally that's effectively delevered. Australian consumers, unfortunately, are not in that camp. So we try to take advantage of some of that high quality income that's available from the US market. We also like to take advantage of illiquidity. So looking at some less liquid credit, both in the private and public spheres, and often they're best packaged in some sort of listed investment trust structure, and bringing all that together as a combination to provide some of that defense and fill that gap in the portfolio allocation.
Now, PIMCO is known as an active fixed income manager. Can you give our clients some insights into some off-benchmark opportunities that we're currently seeing?
Yeah, I'll give you three and I'll sort of explain how they all fit together. So first thing is, we do like inflation-linked securities. While they're not typically in a benchmark, we do think the way they're priced and the way they protect against some surprises in inflation are attractive. We also like things like UK banks. UK banks spreads have been widening because of Brexit concerns. We think that's really not fully justified. As I mentioned before, we also like some off-benchmark opportunities like emerging markets. So especially taking advantage of highly liquid emerging market currencies, providing some additional carry in a portfolio context, but without being very correlated with other positions. So while those three would all be relatively small in a portfolio context, we think they just provide some improved risk-adjusted return expectations.
Thanks for your time today, Rob, and thanks for watching.